It is extremely critical to know when and where to get out of your trade. And it's probably one of the biggest questions or a major concern with most traders who are new, beginners, trying to figure out where to get out of a trade in time so that they don't end up getting stopped out or possibly getting into too much trouble with drawdown. Okay, so if you trade supply and demand similar to how I traded, or maybe just like how I traded, let me show you a little simple technique you can use. Three different ways, pretty much. Okay. Now, some of us will position our stop losses. You know, if you trade with a physical stop loss, or maybe if you have a mental stop loss. Either one. You know, you have to know where to actually get out of a trade immediately. You know, when the market is coming back against you, or you feel as if a trade is not working out in your favor fast enough. And you know me, I'll get out of a trade if I'm in it and it's kind of, you know, pedaling around where it's not really going anywhere, moving quick enough. And that's typically when the volume starts to really drop. You know, if it's around lunchtime, later in the day, it really just depends. Okay. I like to see, and I like to have volume in the market to really take my trades. Okay. And you should know the best volume is typically going to be somewhere between 8 a.m. Eastern time, maybe up until about 11 a.m. Eastern time. Okay. After that, it kind of slows down until maybe in the later on in the session, maybe 1, 2 o'clock. Okay. Now 3 or 4 o'clock, between 3 and 4 o'clock, you know, is a lot. Most times there's a lot of activity goes on there, but you got to be careful because it's kind of how, you know, things are at the beginning of the market, very energized, and towards the close of the market, sometimes lots of erratic movement. Okay, kind of how it is at the beginning when the market is opening up during the New York session at 9:30 Eastern time. Now, you know, I took a trade short from this area right here, and I'm going to use this as a reference area, as an example, to kind of give you 3 areas of where you could possibly position a stop or know when to get out of a trade. All right, I know this is a hot topic that a lot of people are so keen and curious about, as knowing when to get out of a trade. Okay, all right, so let's say, well, let's use this example right here, the supply zone, as a reference area. Okay, now I talked about this before, but I want to kind of reiterate it because people still ask and still have concerns and still issues with this same problem. Okay, now first and foremost, it's all about capital. You know, how much are you willing to really risk when you're in the market? Okay, and you have to understand that there are going to be times where, you know, the banks, institutions, they know where most traders or retail traders are positioning their stop set. And most times it's at the back end of an area of supply or demand. Okay, so if this was the supply zone right here, you can bet your bottom dollar right here at the back end at 45.04 and 3/4 is where, you know, a lot of times they're gonna try to stop. I mean, they're gonna try to test those areas to stop traders out because they know people are probably putting their stops at the back end right here. Okay, and that's why I always talk about give yourself a little bit of breathing room. You know, by a few ticks, because if they ran back up here and tick the tick, okay, or 1 tick above this supply area, then they're gonna stop you out. And people always see this kind of movement where the market retraces back, stops you out, and then it moves in your direction, right? Okay, right at a supply zone and vice versa at a demand zone. So if you're trading supply and demand in this reference right here or example, you know, it was someone who's really wanting to put their stop at the back end of this area of supply. Okay, now this would be for people who are, how do I say it, willing to risk a little more, you know, because you're positioning your stop at the back end of an area of supply. Okay, then, you know, give yourself a little bit of breathing room. Okay, because they will try to test those areas. Now, there's also a second area where you can put your stop at. Okay, this will be for those that are a little bit more conservative in a sense. We'll right here at the midpoint of the supply zone. Okay, so let's say you want to position your stop at the midpoint. The midpoint is going to be wherever you draw your supply zone at. It's going to be the halfway point of that supply zone. Okay, so let's say you position your stop right there. So that's going to allow you not to take on as much drawdown and get out of a trade if the market tends to come back against you. So let's say you got in right here. this was a supply zone. Price taps into it, and then you kind of wait for the break, all right? And then price starts to pull back, and then, maybe taps into the halfway point of that supply zone. You're going to get out of the trade, right? Because if you got to stop there, it's going to take you out, okay? So, and that happens from time to time. Price may tap into that supply zone, and it may not be a zone that price is really wanting to stop at, okay? Depending on how the market's moving, depending on the bank's and institution's interest, they may be interested in testing a supply zone above or something like that. It just depends, Not every zone is going to work out, and not every trade is going to work out 100% of the time. People have to understand that. You just have to know when to get out of a trade, and find a technique or method to be able to get yourself out of a trade. Again, this video is more so and showing you ways or areas, where to potentially place your stop at, depending if you're a very aggressive style trader that's willing to risk a little more, or someone that's more conservative. And then I'm going to show you the very conservative way to put your stop at. Okay, so this would be the halfway point of someone who's conservative of the supply zone here. All right, so that'd be like a the second place you can put it. So price comes back to this area, it taps into the zone. As you can see here, it never even ran up to the halfway point of the supply zone. It immediately started rejecting it, okay? And lots of times what you'll see, and pay close attention to this, is when price taps into a supply or demand zone, if you start to see where there are wicks at the end of that candle, and it starts to move into that zone and wick away from it, okay? Especially if you see multiple candles where it's wicking out at a zone, all right, that's a definite sign of rejection. They do not want to push the market higher, okay? So in this case here, we got a bullish candle followed by a bearish bar here, and price broke lower. So I ended the trade because we got the break of the candle, right? But if this was an example to where price was just wicking out at a zone, you'll see a wick at the back end of a candle, maybe another wick, then that's a clear sign of rejection, like I said. So be very mindful of situations like that, okay? For rejection. Now, the third place you can actually put your stop at, if you're someone that's very, very conservative, okay? Let me show you that. Let's say you're someone that doesn't have much to risk. You don't have much capital. You want to really protect your capital, and you're not looking for much drawdown at all. Basically, you're not looking to see price break or come back across the break-even mark by just maybe a few ticks, okay? So let's say this bullish candle runs up into the area of supply right here, right? Then we get this bearish break to the downside, or bearish candle, that red candle there, it breaks, okay? And then we get the break of the candle right here, the next bar, okay? Now, let's say price returns immediately, okay? All right, after the break here, and turns back, okay? You see that bullish candle right there? What you could do is put your, maybe a stop right here at the halfway mark of that bullish candle, the body of that bullish candle, okay? So, instead of putting it on the back end of supply, or the halfway point of supply, you're putting it on the last bullish up candle. Again, this is in reference to a supply setup. At the last halfway mark of the last bullish up candle, and then when price, you see where price is rejected with the close of the candle in the opposite direction. So you put your stop at the halfway point of that last bullish bar. Okay, so that even protects your trade a little bit more, because primarily, you're probably getting into the trade maybe at the break here at 98 3/4, and price comes back, not even 2 points, maybe 2 points there. We're talking like 6 to 8 ticks right there, okay? So yeah, it does come back above break even, and maybe stops you out at 6 ticks, maybe 7 ticks, maybe less than that, just depends, okay? But either way, that's the halfway point of that last bullish up candle, and then we get the rejection of that at that zone, and then the break of the candle, which I use as a tool or sign that this rejection of the zone and the break of the candle kind of shows me interest that they're looking to take the market lower. In this case, they did at that supply zone. So there's 3 areas here. You got one again at the back end of the area of supply, right above the back end of supply, the halfway point of the area of supply, or at the halfway point of that last bullish up candle that taps into the actual supply zone in this case here. Again, if you're someone who's very aggressive, or aggressive style trader, whatever the case is, and just really looking to maybe risk a little bit more capital, and knowing that sometimes they will come up there and test that full-on blown out that area of supply right there, all the way to the tick, pretty much the back end there, then you may want to you could possibly put your stop at the back end of the supply, Someone that's conservative, you know, halfway point of the supply zone, and then someone that's very, very conservative, don't have much to really lose, and you don't really want to risk or put too much on the table and leverage too much into the market. That last bullish up candle on the tap or taps into the zone, put it at the halfway point there, and that'll protect you even more. But I will say this, in most times, you know, when you get the rejection, they're going to kind of pull back, you know, because you know how the market moves. It's going to push down once it rejects, then pull back, push down, and then pull back. That's how the market moves. It makes lower lows and lower highs, or higher highs and higher lows. That's the way it moves. So you have to understand that if you're very, very conservative, most times you're probably going to, you know, it's probably going to break even, okay, or maybe even stop you out because the fact is you're just putting your stop loss so tight. So, you know, you have to give a little bit of breathing room, okay? But there again, you know, with having taking the very, very conservative route, okay, so you may get stopped out, maybe not lose much, but your winners may be larger than your losses, and that's the key in a sense too, because if you're someone that's very, very conservative, then your losses are going to be very minimal if you get stopped out. But the thing about it is you could get stopped out more frequently. It just depends. But if you get into the right trade, your winners should be larger than your losses ultimately, okay? So, you know, you may get stopped out more, okay? You may have a 60 or 70% win rate or whatever the case is because you're getting stopped out more frequently because where you're putting your stop at is a lot tighter of an area or a lot closer to the area from your point of entry. But if you allow your runners to run and you pick up like on this trade here, let's say you got in at 98 and you took price on down to the low right here at 91, okay? So what did I say, 98 to 91? Yeah, so you picked up 6-7 points right there, okay? Versus taking a 6 or 7 tick stop. You know, we're talking, what's that, a 1.5, 1.75. So, you know, if the trades tend to work out more so in your favor and you get a couple of stop outs by just a few ticks, then you should be okay. But you just have to, it's all up to the person, you know, where you want to place your stop at, how comfortable you are where you place your stop at, how much in relation to how much money you're really looking to leverage in the market. But it's a matter of really gaining the experience and, you know, back testing and understanding and seeing those areas where they can possibly, like I've shown you before, run up to. And a lot of times they want to test those back end of areas supply or demand. But again, I just want to show you some areas to where you can position your stop, all depending on your type of trading or what type of trader you are. Are you very aggressive? You're conservative or very, very conservative type style trader, okay? Either way, if you're interested in joining our Discord, find the link down in the description portion of the video below and come and join us on the daily over on the trading floor channel on the Discord, okay? Outside of that, that's all I have for you guys in this video. Please do me a favor and click on the like button if you found value in the content in relation to talking about, you know, position of where, you know, you could possibly put your stop loss according to or depending on what type of trader you are or style of trader you are. But outside of that as well, make sure to sub to the channel if you're not a current subscriber and click on the bell next to it to turn all your post notifications on so you never miss one of the uploads or any content here on this channel, okay? Please do yourself that favor, but more important, please drop a like on the video. See you guys, take care.